In this video, traders, we're going to look at how you can objectively assess and identify the trend. Stay tuned. Hey traders, warm welcome to you. So the best way of identifying the trend, in my opinion, is to get your chart up, look at your chart and see what is going on. If you need to, flip it to a line chart, look at it and say, hey, you know what, that's my trend, whatever time frame you're looking at. Now, an uptrend on a daily may well be a downtrend on a monthly, uptrend on 1 minute, downtrend on an hourly. We know that's the score. However, in this video, what I want to talk about is how we identify the trend, perhaps if we're using it as a yes, no binary signal, as if we were putting it into an algo, as if we were putting it into a scanner, something where we haven't got objectivity with it. In other words, no eyeball, which I believe is best if you can, but something that says, hey, yes or no, that isn't a trend, that isn't a trend. So the first one is moving averages. Moving averages are seriously useful for this kind of thing because we can have a slow moving average and a fast moving average. When the fast moving average is above the slow, we can say it's an uptrend, and we can adjust those speeds to suit. So in other words, we can say, hey, when the 100 period daily moving average is reasonably slow, when the 100 is above the 200, it's a longer term trend. So in other words, we could be running down for quite a while, but ultimately over a long period of time, we're in an uptrend. Or we could kind of shorten things off and say, okay, when the 20 period is above the 50 period, we're in a trend. So it's quite a tight high trend. So we can adjust it and suit and play around with how we like with that. So we can have one moving average crossing over another moving average. And that will also tell us the direction of the trend as well. So if the quicker moving average is above the slow moving average, we're in an uptrend, and vice versa. If the quick moving average is below the slow moving average, we're in a downtrend. And you can also play around with multiple moving averages as well if you like. So you can say the strength of the trend is greater when the quicker moving averages are all above each other. So the 100 is at the bottom, then you've got the 50, then you've got the 20, then you've got the 10, for example. Whereas if one is crossing the other and the trend isn't quite as strong and it may be a pullback in a trend. So you can play around with those, or alternatively, you can have price above or below a moving average. Very nice, simple, easy filter. That's going to give you a logical binary answer, yes or no. And you can configure that to suit. So that's a good way of doing it, and it gives you the direction. So I'll give it 2 ticks for that one. Number 2 is linear regression. Linear regression is a nice little tool actually. Play around with it on your charts yourself if you fancy this. This will adjust and snap to, and we'll basically put a trend line in. So for example, if we had, an uptrend here, it would snap a trend line to that and would put bars around it, however many standard deviations you set it to. So you can put it to 2 standard deviations is normally the average setting, and the distance you set the actual linear regression settings to. So the look back is normally 100, so it looks back 100 bars and bases that on 100 bars. You can shorten it if you're looking for a shorter trend, you can widen it if you're looking for a wider trend, and that will just adjust its angle. So in other words, if it's got an angle that's pointing up, and depending on where you're calculating from, whether it's from the top point and you're saying, okay, well, it's less than 90 degrees or it's more than 90 degrees. So less than 90 degrees, then we've got an uptrend. If it's more than 90 degrees, then we've got a downtrend. And that's going to have to be how you adjust it and how it's actually displayed in your specific charting package. But you can see that that is an objective view. You basically can say, okay, well, if it's 45-degree angle or above, then it's an uptrend. Or maybe you don't have to go as aggressive as that. You could say 30 degrees. You get the point. Sorry, you could say, if we were using from the north all the way around, we could say something like, okay, well, it's got to be between, 0 degrees, that would never happen, but between 0 and say 80, because we don't want it to be like flatlining, we want a little bit of an uptrend, but you can adjust the strength of the trend depending on the angle of the linear regression. So that's a binary event as well. And again, we can say if it's an uptrend or a downtrend. So we can see, yes, it's trending, it's up, or it's trending, it's down. Another one is ADX, which is the average directional index. This is a indicator that generally, if readings are above 30, it would indicate that you're in a trending environment. Now, the only downside to this is that it won't tell you the direction. So you could say, hey, we're in a trending environment if ADX is above 25, if ADX is above 20, then tick the box for a trend, else no. Very simple way of identifying if the market is in a trend or not. However, like I say, it won't tell you the direction of the trend. So if you need that, then the ADX isn't for you. Final thing is number 4. This is a little bit of a grubby way of doing it, to be honest, but it's possible if you want to try this out. Multi-time frame oscillators. So in other words, An oscillator really is an overbought or oversold condition, and you can get into an overbought condition when you're in a range-bound environment. However, you probably could just about manipulate it over multiple time frames and say, well, if I'm overbought on all the time frames, I'm probably in a trending environment. And if I've been overbought for a reasonable period of time as well, I'm probably in a trending environment. I don't think it's anywhere near as clean as the others, if I'm honest, because you're kind of using the wrong tool for the job. Oscillator is much better at gauging pullbacks, better in range-bound environments, that kind of thing. It's not really the right thing, but you know, perhaps it's something to explore if for some reason these don't tick your boxes. Of course, you can almost say the direction of the trend, but it's calculated slightly differently. But in theory, very strong overbought on multiple time frames for a long period of time will indicate a strong uptrend. Very strong oversold or long oversold on all the time frames will indicate a downtrend. And if you've got maybe a shorter time frame oscillating the other way or back to neutral, you could perhaps say that it's not as strong a trend. However, it could still be in the trend. So it's not quite as clean, like I say, but it's there and it's feasible, it's possible. Moving averages are a great one to use. Linear regression is a great one as well because of this, the way it snaps around depending on how far you're pushing it back. And the ADX is another good one to see if you're just in a trending environment. So play around with those. These, like I say, I don't think anything's as good as actually looking at the chart yourself. And if you, let's say, put it to a line graph, very easy to visualize. But if you need something that has an output that is yes or no, or has a number that you have to put into then a filter, a screen, or perhaps some kind of algo or gray box, whatever it may be, those ones specifically are the ones to try. And then if you can't figure out something like that, the fourth one of multi-time frame oscillators. If you've got any more or ones that I've forgotten, stick them in the comment section below. I'm sure there are other ones that come to your mind, and appreciate your like if you enjoyed the video. Take care, guys. See you next one. Bye bye.